Recording in progress.
Okay, so welcome to today's session. So what I'm going to do is just to give you a brief introduction to one of the very interesting topics in taxation. So whether you're doing CA 2.4 or you are doing CA 3.4, this is a topic you have to face. And I can tell you the truth, it's the easiest topic that you can actually come across. But I think for me, when you talk about taxation, I think tax is I would say it's the easiest course to clear if you are doing accountant studies. The reason is tax is not mathematics. Taxation is law. And as such, if you know the tax laws, then you must be good to go. So what is expected of you is just to know the principles. What does the law require you to do? So how does the law require you to treat certain transactions? So once you establish that, I think you will be good to go. With that said, so let me just introduce you to a subject of capital allowances. Briefly touching on capital allowances. I'm not going to do any computations today, but I'll just give you the principles of capital allowances. So the capital allowances that you learn in 2.4 are the same capital allowance you're going to learn in 3.4, except you might face a few exceptions or few advanced techniques on 3.4, but basically you're talking about the same thing. So allow me to share my screen and just run you through this interesting topic called taxation. All right. Okay. So look at capital allowances. My name is Kelvin. I'm a tutor from Better Starts Corporate Services. So that is our business. And the objective really is just to help our students to have it easy in their examinations. Accounting studies are not the easiest, I must confess. But I think with the right guidance and then the right coaching, you should be able to sail through. All right. So let's look at capital allowances. The concept of capital allowances. Allow me to start from financial accounting. So how do capital allowances come into play? So allow me to take you back to financial accounting for those that did financial accounting. All right. So in financial accounting, there are what we call policies, accounting policies, that the standard do allow us to use when we are computing accounting profits. Okay. So basically, when you're looking at taxation, the policies that we use or the rules that we use in the computation of accounting profits sometimes do conflict with the tax legislations. For some reason, the taxman said, no, you know what, we can't rely on the accounting profits in order for us to determine how much money we should levy on a particular business. The reason is this. In accounting, we use a lot of estimates sometimes. There's a lot of professional judgment going on in the preparations of the statements of the statement of financial position, in the calculations of profits in the income statement. We use a number of estimates. All right, and these estimates, you would find that they are not uniform from company to company. As such, for example, if you gave me to prepare certain financial statements I'm going to prepare them. I'm going to use certain judgments. Obviously, the standard just require me to be prudent. Okay, that's how come we have the prudence concept. So it just requires me to be prudent in the way that I'm going to apply the estimates and other policies. So one of these policies that a business can come up about in accounting is depreciation. So when you look at depreciation, companies do apply different depreciation rates. Okay, so a depreciation is basically charged to the income statement as an expense. All right. So what that does then is it reduces your profit for the year because you're charging it as an expense. So you charge it against your income statement as an expense. But in actual sense, a depreciation charge is not a money, is not a cash item. Okay. So it's not a cash item, it's an approximate rate that is applied on the non-current assets. So when you buy non-current assets to be used over a period of say 5 years, all right, so your company is going to decide to say, okay, we are going to use this asset for 5 years, and after 5 years, I think we should dispose it off. So what then they are going to do is if the vehicle was purchased for 250,000 kwacha, for example, a company is going to say, okay, so this vehicle every year will be depreciated at 5%, for example. Another company can decide to say this vehicle will be depreciated at 25%. Okay. Another company can decide to say, okay, this vehicle will be depreciated at 35%. So now look, different rates have been applied here. So there is inconsistency in the application of these rates by different companies. So then how do ZRA try to remedy some of these things? Then the taxman comes and says, okay, what we are going to do is we are going to formulate what we call capital allowances. All right, so capital allowances are basically a form of tax relief given on capital expenditure. You've got depreciation in accounting profits, but in the taxable business profits, we are going to talk about capital allowances. All right. So capital allowances are a form of tax relief on capital expenditures incurred by businesses. So for tax purposes, capital expenditures are not deductible when arriving at the taxable business profit. All right. For tax purposes, capital expenditures are not deductible when arriving at a tax element. So just a reminder to income tax law. So just a reminder, the income tax law requires that accounting profits be adjusted when determining accounting profits. As such accounting adjustments are added back to the accounting net profit when determining the taxable business profit. So we are going to look at these terminologies and then we're also just going to understand how then we make these adjustments. All right, with that said, in tax, the carrying amount after deducting capital allowances is called the income tax value. So what is the income tax value? So now let me take you back to financial accounting. All right. So in financial accounting, when you acquire an asset, you are going to acquire that asset at cost. All right. Then at the end of the year, you apply the depreciation charge. So as you report at 31st December, whichever accounting period that you have, as you report the value of that particular asset, which we call the carrying amount. Okay. So if you in financial reporting, the word used is the carrying amount. At a financial accounting, the common word used is the net book value. Okay. So the book value of that particular asset as of December is what we are referring to as the income tax value. So in financial accounting, it's the net book value because it is net of depreciation charge. It is net of the accumulated depreciation charge. But when we are in taxation, we are looking at the income tax value. So the income tax value is the cost minus the capital allowances. The value that remains is what is referred to as the income tax value. All right, I hope that makes sense. Let's go. All right. So now let's look at expenditures that qualify for capital allowances. Not all capital expenditures qualify for capital. Not all capital expenditures qualify for capital allowances. That's the typo there. So the income tax contain the type of capital expenditure qualifying for capital allowances, and these include the following. So what we are saying here is that not every capital expenditure will qualify for this particular allowance, but the Income Tax Act does give us guidance on the types of assets or types of expenditures that would qualify for capital allowances. The first one is implements, plant and equipment, or implements, plant and machinery. So any capital expenditure on implements, plant and machinery do qualify for what we call the capital allowances. Then the other one that qualifies for capital allowances is industrial buildings. So capital expenditure used in the development of industrial buildings does qualify for capital allowances. And then the other one is the commercial buildings. So capital expenditure on commercial buildings do qualify for capital allowances. And then the other one, you're going to talk about the farm works and improvements. So for those that are in farming business, the farm works and improvement does qualify for capital allowances. All right. Implements, plant and machinery. So then how do you determine which one is an implement, plant and machinery? So the income tax value does not provide a definition of a plant. Okay. As such, cases or case laws provide guidance as to what is plant and what is not plant. All right. So in the case of Yarmouth versus France, Lin LJ said, it is, in its ordinary sense, plant includes whatever apparatus is used by a business for carrying on business, not his stock in trade, but all goods and charters, fixed or movable, live or dead, which he keeps for permanent employment in business. So that is according to Yarmouth and France. So that is how it defines a plant. So a plant is not any good that you hold in a business for trade, all right? A plant can be something that I use I employ in my business for me to just run the business. For example, a machinery, okay, that can qualify to be a plant. So in some cases, items which may not appear to be plant have been held to be plant, and vice versa. So the case of Manby versus Fanlong, the law books of the barrister were held to be plant. So for example, I am an accountant, and in an event that at some point Virtuous Tax Corporate Services becomes a registered firm with the Zambia Institute of Chartered Accountants, and I happen to be the managing partner of this accounting firm. At that point, maybe my books, the books that I'm using, or the materials, the standard books may be considered as plant because I'm using them or I'm employing them in offering a service to businesses in the preparation of financial statements, or offering audit services. So that's what was held in that case of Manby and Fanlong, to say the law books of a barrister is plant. Then the general guidance to distinguish the setting in which business is carried on and the apparatus used to carry on business. So that is another definition of what plant is. So implement, plant and machinery. So for exam purposes, and I repeat, for exam purposes, the following qualify as plant, as implement, plant and machinery. So for the sake of that exam, general plant and machinery, fixture, fitting and furniture, motor vehicles, fire safety equipment must not be part of the structure. So for a fire safety expenditure that you develop, it should not be part of the structure. For example, a chimney, okay, a chimney should not be a capital expenditure at that particular time. I'm going to touch this slide, and this will be my last slide. If you want to learn more on capital allowances, call me and we are going to schedule a meeting. You have to pay for the service, and I'm going to employ my time and teach you. I'm going to show you how to calculate each capital allowance. And I'm going to show you how to then insert this calculated capital allowance into a full exam question, a comprehensive exam question, be it first question which carries 40 marks, or be it the questions that come in section B. So I'm going to touch on this slide. So capital allowances on implements, plant, and equipment are available in the form of wear and tear. So the wear and tear allowances are based on the cost of the qualifying expenditure. Okay, so the wear and tear costs are based on the qualifying expenditure. And again, qualifying expenditure, what does it mean? Well, remember in the first instance, I said capital allowance are applicable on the capital expenditure of an asset, all right? So sometimes it is not the entire cost that qualifies for capital expenditure, especially in an instance when you're dealing with commercial buildings and you're also dealing with industrial buildings. So we are going to look at those types of capital allowances, and then we are going to understand which one is the qualifying amount and which one is not the qualifying amount. All right. But with that said, let me just run you through. So the standard rates applicable for capital allowances are as follows. All right. So for implement, plant, and equipment, it's 25% on cost. So if you buy a motor vehicle, all right, if you buy a machinery at a cost of 50,000 kwacha, then 20%, 25% of that cost will be a capital allowance claimable against your business profits. All right. Then used in tourism and manufacturing and leasing, you claim capital allowance at 50% of cost. So if an equipment that you bought is used for manufacturing, it is used or it is employed in the tourism industry, or it is employed in the leasing industry, then you qualify for capital allowance at 50% on cost. So that 50% will be a capital recovery against your profit in the computation of business profits. All right, then used in farming and agro-processing. So if you buy an equipment that is supposed to be used in farming or agro-processing, then that will qualify for 100% on cost. So it's like you buy an equipment that is going to be used. For example, I buy oil expeller or something that I'm going to use to process the goods produced by farmers, say for example, producing cooking oil and all those stuff. So I'm using it in processing and agro processing. The taxman allow us to claim capital allowance at 100% on cost. So if I spend 50, I claim 50. The reason that is done is to encourage farming as well as encourage agro processing in the country. So that's why you would claim capital allowance at 100%. Commercial vehicles. So a commercial vehicle, a truck, a tipper truck, those would qualify for capital allowances at the rate of 25% on cost. Then we've got non-commercial vehicles. All right. So non-commercial vehicles, these are vehicles that are not used as commercial vehicles. For example, a pool vehicle. A pool vehicle qualifies for capital allowance at the rate of 20%. A commercial vehicle is a road vehicle that is not commonly used as private vehicle and unstable to be used as such. but includes all vehicles used solely to hire or carriage of public for a reward. So a buses, a rolling, uh, uh, which other one? Canter trucks, tipper trucks. Those are commercial vehicles because you can't give a canter to a managing director as personal to order vehicle. I mean, it can't just because that vehicle is not meant for such, or you can't give that highest bus to the chief financial officer as his personal to order vehicle because that vehicle is not meant for such. It is a commercial vehicle. All right. So the vehicles that you then use for private use, for example, Toyota Hilux, then that vehicle would qualify as a non-commercial vehicle, and they're going to claim capital allowance at 20%. All right. So I think I've given some examples there in terms of what vehicles would qualify as non-commercial vehicle. There we've got the saloon cars, station wagon, etc. And then the lorries and other vehicles of similar nature, pickup trucks and other vans would qualify as commercial vehicles. Qualifying periods is not something I'm going to talk about in this lecture. It was just a sample lecture of something that you expect from me, and obviously now I'm going to give you some questions. But what I would do is I'm going to sacrifice one topic one of these weekends. I'm going to record a full lecture, and I'm going to post it on my YouTube, so you can go there and learn. And obviously, I'm going to do it, I think, on introduction to taxation, and that will be the topic that I'll record and put it on my YouTube channel. Introduction to taxation, but the most technical aspect of this course, obviously, you have to engage me, and then we need to make a plan on how we can cover this. Thank you so much, and be blessed.